Today, is there mortgage trouble ahead? Hello again, it's Martin North from Digital Finance Analytics. Welcome to the latest posts covering finance and property news with a distinctively Australian flavour. Just before I start, a quick reminder, tonight at 8 p.m. Sydney time, I'll be running my next live stream with Damien Klassen from Nucleus Wealth, and we'll be talking about certainty investing, a very important topic in the current times. But now I want to talk about the mortgage market. And there are some very interesting and worrying signs that things may not be as well as officially reported. The end of a $200 billion Reserve Bank funding scheme is expected to push mortgage rates up from their current ultra-low levels and dampen the red-hot demand for housing. The RBA launched the programme, the Term Funding Facility, or TFF, last year in an effort to mitigate the economic impact of the COVID-19 pandemic. Australia's banks only have about 6 more weeks to draw down on the $90 billion of cheap funding under the scheme, according to recent reports. Under the TFF, banks are able to borrow from the RBA at a, wait for it, 0.1% interest rate, which has helped push fixed rates on mortgages below 2%. The conclusion of the TFF will leave banks more reliant on wholesale markets for their funding, which will increase their funding costs, although it's worth noting they have 3 years to repay their TFF facilities. Those extra costs will likely be passed on to customers through higher fixed rates, potentially throwing some cold water on the red-hot housing market. Credit market expert Dr. Phil Bailey, the principal of ADCM Services, estimates that if banks were raising 3-year funding on the domestic market rather than drawing on the TFF, they would need to pay about 0.25 percentage points over the 90-day bank bill rate of 0.04%. It may not look that much, but it would be an effective tripling of the current costs, Bailey said. I think we can expect to see mortgage rates moving up gradually after the 30th of June. Matthew Wilson, an analyst at Evans and Partners, said that the TFF had contributed to the proportion of new fixed-rate loans, more than doubling to about 35% of all new mortgages. The availability of the TFF has enabled banks to strategically offer low fixed rates, Wilson said. And he said that when the programme ends next month, banks will remove their cheapest fixed-rate deals from the market. CBA actually may be a bellwether for future hikes. It increased its 3-year fixed rate by 0.05% on Friday, and longer-term fixed rates are also creeping up in response to rising bond yields. The RBA has repeatedly said it does not expect the cash rate, which affects variable rates, to move until at least 2024, or that might be rather optimistic. Prior to the COVID-19 pandemic, Australian banks raised more than $100 billion annually in wholesale funding from foreign and local investors. However, the bank's debt issuance slowed dramatically during the pandemic as lenders were inundated with deposits and as they accessed the TFF. So far this year, banks have only raised about $5 billion in the domestic market and $15 billion internationally. David Plank, the head of Australian economics at ANZ, said that from the second half of 2021, banks will start issuing more wholesale debt and that there would be upward pressure on 2- and 3-year fixed rates, which would have some effect on the housing market at the margins. However, Plank said that he didn't expect major change as a result of the rise in bank funding costs. He said that the ANZ still expects house price growth to be 17% this year. Andre Murray, chief executive of Curve Securities, said it would take time for the end of the TFF to have a big impact, but it would cause a small hike in rates on term deposits and fixed-rate loans. If I had a loan I wanted to fix, I would certainly be looking to lock it in for 3 to 4 years, he said. There's very little risk of it going lower. Experts said that the rate rises would be limited by the degree of household leverage. Wilson said that the average home loan had spiked from $366,000 in 2010 to $575,000 today. That rise in household indebtedness means any increase in the cash rate would need to be very gradual, he said. If the cash rate goes up by 100 basis points, you could start to see some real pain. And social restrictions may have eased and the property market may be booming, but the impact of COVID-19 can still be felt. According to research from Finder, nearly 1 in 3 home loans is in arrears, meaning that around 899,000 mortgages are behind on payments by at least 30 days. Almost 1 in 5 mortgages, actually 18%, are in arrears by 30 days or more, 8% by 60 days or more, and 5% are considered seriously delinquent as they're behind by 90 days or more. COVID-19 put a lot of households in a precarious financial position, said Finder home loans expert Sarah Megerson, who pointed to unemployment as one reason why people are struggling to keep up with their loan repayments. The Australian unemployment rate, while dropping, was at 5.8%, seasonally adjusted at the time of going to print. The fact that the unemployment figure is falling is not the positive that it seems either. The underemployment rate increased to 8.5% in February. It was considerably higher for females who have been more affected by job losses during COVID-19. According to official figures, in May 2020, almost 98,000 fewer university-educated women were working than at the start of the pandemic. This compares to 37,000 fewer men. Despite that, men are much more likely to be behind on their mortgage repayments than women. 80% of female homeowners are up to date with their repayments compared to 59% of men. Megerson said that many were also concerned about what would happen once JobKeeper was wound back at the end of March, with some homeowners now only a few missed mortgage payments away from potentially having their homes repossessed. This is no doubt a scary time, Megerson said. The JobKeeper program has supported more than 3.5 million workers in the past year. According to the ABS in February, more than half of those receiving the support were on the higher payment of $1,000. Of those receiving JobKeeper payments, 73% reported receiving less income than they earned with their usual pay, and 25% reported that they were mainly using the funds from the scheme for their mortgage or rental payments. It's no wonder, therefore, that people are nervous about what will happen now. At a Senate committee meeting in March, Treasury warned that around 150,000 Australians could lose their jobs now that JobKeeper has come to an end. In an interview with MPA last year, S&P Global Director Structured Finance Aaron Kitson said the real figures for both unemployment and mortgage arrears was probably being masked by the JobKeeper stimulus and mortgage relief measures. Not everyone is struggling with mortgage repayments, but at the other end of the spectrum, thousands of Australians are actually joining the property market. New home lending ended 2020 at record levels, and interest rates are at an all-time low, meaning people can borrow tens of thousands more from the banks without a spike in monthly mortgage repayments. RateCity.com.au reports that the average home buyer mortgage repayment has dropped since the previous housing peak in October 2017. And analysis of owner-occupied interest rates by Rate City and property prices by CoreLogic show that mortgage repayments are now $140 less a month for the average new home buyer than they were at that time. That's because the average owner-occupier interest rate has since dropped by 1.42%, according to Rate City. But the falling mortgage repayments are pushing up property prices, said Rate City Research Director Sally Tyndall. Ultra-low interest rates have put a rocket under the property market, and it's showing no signs of slowing down. While low rates are driving current prices north, predictions of up to 20% property price rises over the next couple of years are pushing people to panic buy. Tyndall said, first it was toilet paper, now it's property. People are rattled because they don't want to miss out. The reality is, thousands of families have already or will soon find themselves priced out of the market, particularly in hotspots such as Sydney and Melbourne. While the RBA is unlikely to raise rates to keep a lid on the market this year, the regulator could respond by putting caps on risky lending for some borrowers. And mortgage rates do look set to rise. In a research note, ANZ economists Felicity Emmett and Adelaide Timbrell said also that they expected property price rises of around 17% across the capital cities in 2021. The first half of 2021 is likely to be stronger than the second half, they wrote. By June, ANZ Research expects prices to be rising at a more moderate pace, given the end of government programs like JobKeeper and HomeBuilder and the lift in fixed mortgage rates. The chief executive of Pepper Money, which listed today on the ASX, says major banks are getting more selective about the mortgage customers they take on, which should help the non-bank lenders grow as it targets non-conforming borrowers. Mario Rehn said some major banks were finding it tough to process mortgage applications quickly because they were too big to conduct bespoke assessments on borrowers who fell outside the standard cookie cutter, while constant changes to credit policies were frustrating mortgage brokers who were not sure if non-prime customers would be accepted. These dynamics provide opportunities for Pepper, which listed today with a market capitalisation at $2.89 and an offer price of $1.27 billion. Pepper, who has a $10 billion mortgage book, makes 95% of its loans through brokers and provides decisions for all loans within 24 hours, while customers using its product selector technology can in fact get an indicative approval in 2 minutes. 52% of its mortgage book is customers who would not qualify for credit at a major bank. Pepper made $106 million net profit from $352 million of interest income in 2020, and it expects this to lift by 14% this year. Its loan losses of $56.7 million in 2020 is forecast to fall to $44.5 million in 2021. On interest income forecast, it will remain stable at $356 million. You do expect a slightly more adverse performance profile to the major banks, but it is definitely in line with the level of risks we're willing to take, he said. Pepper will join Resimac and Liberty Finance on the ASX as a new non-bank lending sector emerges, and La Trobe Financial is also considering a float. Major bank analysts say some risks for the players, which are funded by capital markets, not deposits, are the same as for the bank, such as the prospect of tougher regulation, growing competition, and information technology. Goldman Sachs analyst Andrew Lyons said in a report last month that another risk for Pepper was its exposure to higher risk non-conforming lending, as well as potential deterioration in funding markets. RBC Capital Markets analyst Tim Piper has pointed to rising interest rates as another dynamic to monitor, given that increased net interest margins are something Pepper and other non-bank lenders may not see to the same degree as the banks. But the analysts also point to the potential for growth in areas where the major banks fear to tread. Mr. Lyons noted, "We acknowledge that the major banks have historically relied on automated credit scoring models to originate and underwrite, which does not leave them well equipped to originate non-conforming loans." 24 hours before Pepper was due to hit the ASX, Mr. Raynham admitted to some pre-float nerves given volatility in the markets. This has resulted in a few prospective IPOs being shelved, including pub operator Australian Venture Co., another asset owned by KKR, and retailer Best and Less, since Pepper raised its funding in the first week of May. In late April, Pepper's advisors reduced its pricing to a multiple of 10.5 times profit, about a 30% discount to where Liberty was trading after it popped after its ASX listing in December. This saw the Pepper raising being upsized to $500 million, almost twice that amount of demand from potential investors. This has allowed Pepper to influence its investor base, which Mr. Graham hoped would provide some stability in the aftermarket. What gives me comfort is the calibre of investors on our register. He said, "We were way oversubscribed and we have the ability to pick and choose." Pepper is targeting a dividend payout ratio of between 30 and 40% of its profits, lower than the major banks, which are paying out about 65%. Pepper says it wants to preserve some capital for growth. Despite higher funding costs, the higher average interest rates Pepper charges on its mortgages compared to banks allows it to earn a higher net interest margin. The net interest margin, the main revenue driver, of course, was 2.66% in calendar 2020 and is expected to fall to 2.51% this year. This gives them a higher rate than the net interest margins at the major banks, which is around 2%. Given it doesn't have deposits, Pepper funds itself from residential mortgage-backed securities and warehouses. There is $7.5 billion in warehouses sitting in 10 facilities from 15 different funders, including Westpac, Commonwealth Bank and National Australia Bank. And Pepper raised $4.8 billion in 2020. That's a record level despite COVID-19. And as at 12:30 today, Pepper began trading on the ASX under the ticker code PPM. Commencement of trading on the ASX on a normal settlement basis is expected on Thursday the 27th of May. Under the IPO, the company will issue 173.2 million new shares at an offer price of $2.89 to raise cash proceeds of $500.1 million. And following completion of the IPO, the company will have 439.5 million shares on issue and a market capitalisation of approximately $1.3 billion at the offer price. And Pepper's listing will be closely watched by La Trobe, who is reported as looking for an IPO or a trade sale. And finally, sobering words in the AFR's Chanticleer today. Hamish Douglass, the executive chairman and chief executive officer at Magellan Financial Group, admits he hasn't found it this hard to predict the direction of financial markets since the depths of the global financial crisis. On one hand, vaccine rollouts have helped economic growth accelerate, and markets could ride that for some time. On the other hand, there's what Douglas calls risks hiding in plain sight. What if vaccines can't control emerging COVID-19 variants? What happens to the speculators who flooded the markets in the past 12 months, including in the private cryptocurrencies Douglas describes as purely imaginary? What happens if central banks are wrong on inflation? It's a laundry list of lingering worries that would be familiar to investors big and small. As Warren Buffett's wingman Charlie Munger said at Berkshire Hathaway's annual general meeting earlier this year, if you're not a little confused by what's going on, you don't know it. But for economist Kevin Walsh, a former governor of the Federal Reserve, who famously helped steer the Fed's response to the GFC, investor confusion is understandable. It's hard for markets to understand and calibrate when the rules of the road have fundamentally changed, he says. The sudden end of the idea that governments need to live within their means is just one example of these new rules. The reversal of decades of globalization is another. But perhaps the biggest rule change is that prices in financial markets, which are supposed to act as judgments on the future, are being distorted because the largest bidder for many of these markets are governments who've thrown trillions of dollars at buying bonds and other debt instruments. At a time of massive regime change in the conduct of governments and economic policy, financial markets are being asked to take in a lot. Walsh is well placed to comment on regime change. Having started his career at Morgan Stanley in 1995, he became a special assistant to President George W. Bush on economic policy in 2002, working closely with Ben Bernanke, then chairman of Bush's Council of Economic Advisers. When Bush picked Bernanke to become Fed chairman in 2006, he also nominated Walsh to become a Fed governor at the tender age of 35. I thought this was going to be a nice, relaxing way to spend some time after killing myself with all-nighters for 4.5 years in the White House, Walsh said. The GFC took care of that. Walsh, with his banking experience and connections, became Bernanke's prime liaison to Wall Street as the crisis unfolded. In some sense, it was scarier because markets didn't appreciate the fear. When markets are scared, in some sense, they're doing their jobs and they're policing. When markets are calm, when the VIX is low, that's when government officials, frankly, should be quietly scared. Walsh credits Bernanke for coming up with the Fed's original quantitative easing program in 2008, which saw them buy $600 billion US of mortgage-backed securities. But he was critical of the decision to launch a second round of QE in 2010 when the economy was getting back on its feet. I was concerned at the time that if we did QE2, then we'd end up doing QE3, 4, 5 and 6, and it will become a rather permanent feature of the monetary policy toolkit, he said. Because if in fact we've gone to a world where QE is standard operating procedure, governments, economies and markets can all grow to depend on it. Walsh, who was interviewed by Donald Trump for the job of chairman of the Federal Reserve but lost out to Jerome Powell, is clearly staggered by the fact that the QE is continuing today in a US economy that has roared back following the pandemic. The mix of fiscal policy, monetary policy and the rest have conditions looser than they were in the darkest days of the global financial crisis of 2008 or 9, or any day in between. Yet another example of regime change, he says, is the willingness of the Fed and other central banks, including the Reserve Bank of Australia, to wait for inflation to arrive rather than looking out over the horizon and trying to anticipate it, as central banks have traditionally done. His fear is that if the Fed is wrong and the inflation currently building doesn't prove to be transitory, central banks may have little room to move. We see what I think we could safely describe as bubbles across many parts of the world's financial markets. We have to ask ourselves the question, if it's a bubble, when will it burst? The answer, Walsh fears, lies in applying aggressive medicine to a patient that is largely healed in the US, and then seeing an inflation outbreak that forces the Fed to raise rates long after the horse has bolted. The longer they wait, the more expensive it will be. The bigger the shock it'll be to the markets, the bigger risks it'll be to the real side of the economy. My guess is we're going to see increases both in volatility as well as in the volatility of volatility as we're racing through the next 12 months with a series of facts that we can only hypothesize about. But if I look broadly across assets, I would say our governments have been trying to bid up asset prices for most of the last dozen years, especially over the last 12 months or so. What happens if the governments either are forced to exit being such a big participant in these markets because of inflation, or the markets decide to exert their own influence over governments, something which happens quite frequently in foreign exchange markets. So standing back from all that, you can take out, I think, three things. Firstly, there are considerable pressures on the mortgage market in Australia emerging now, and we would expect to see some higher prices. We also know that many people are in financial stress at the moment, as we report, and that will turn to questions of delinquency later. And more broadly, the AFR article highlights that we are on a precarious knife edge at the moment, with potentially too much quantitative easing chasing its own tail, and frankly, no exit path. So this is further evidence, in my view, of things yet to transform into something really strong and long-lasting, and more likely signalling more disruption, volatility, and potential market falls ahead. So once again, watch your back and be cautious. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.